Hello everyone, my name is Josh O'Connell and this is episode 8 of Irish Tax Unwrapped. Whether you're a business owner, an investor or just curious, we break down Ireland's tax code for everyone. Now picture this, it's 11:25. You're a peasant and your boss is a guy with a sword. Your motivation for working hard is not getting your head chopped off. Fast forward 900 years and you're being offered free gym membership, pizza Fridays and stock options. In this episode, we explore one stock option in particular, growth shares. A sleek modern way for rewarding employees, right? Beneath the surface, they trace back to a far older tradition. Settle in, we're about to break it all down. First, let's kick off with a review of the latest tax stories. Welcome back, Daphne and Derek. Tell me, what interesting stories do you have this episode?
Well, Josh, the latest tax defaulters list was published. And on it this time round, there's a well-known Irish property developer. His company is on it, facing over €500,000 in unpaid taxes, interest and penalties. What's striking, though, is that the developer himself went public. He gave interviews, he put a statement out on LinkedIn. He's trying to shape the narrative, right?
The company donated to charities that weren't officially registered. No registration means no tax relief. From there, it spirals. A VAT claim on expenses unrelated to actual business activities. This wasn't a grey area, it was pretty clear-cut.
Wait, so he went on LinkedIn like, hey everyone, no big deal, just a little tax misunderstanding. That's the move?
Yeah, I read that, and honestly, I was fascinated. Like, why go public? That's a bold PR choice. But once you dig into the details, it doesn't seem like this was some nuanced misunderstanding.
He also reclaimed VAT on a potential investment.
The VAT issue, that's like trying to write off a weekend in Doolin because you jotted down a business idea on a beer mat. Just because it happened near your work doesn't make it a business expense.
You mentioned off air how easy these issues are to check, right? But he's thrown his accountants under the bus saying, if your accountants say it's okay, don't listen, strip those costs out.
That's the part that gave me pause. Because blaming your advisors, that's almost a reflex.
That's up there with the dog ate my homework, isn't it?
When I hear someone say, we relied on advice, I'm like, did you? Or did you just not like the advice and plough ahead anyway?
What's interesting is how people can anchor themselves to one accurate detail and then use that sliver of truth to justify an entire narrative. He mentioned the cost of appealing. And yes, appeals can be expensive, but that doesn't mean the rest of his argument holds up. Being partially right doesn't exempt you from being mostly wrong.
That line about the appeal, it's giving I don't want to find out I'm wrong vibes. That's a bold strategy for €500,000.
Yeah, I mean, look, I get it. Legal costs are intimidating, but we're not talking about a couple of thousand here. This was a significant amount of money. If I really thought I was in the right, I'd be in that appeal process so fast. The fact that he walked away kind of suggests he didn't think he'd win.
And there was no qualifying disclosure either. I found that strange. There are tools built into the system to help when things go wrong. 2 key options, an appeal or a disclosure. And they use neither in this case.
So, if you zoom out a little, this story about a simple misunderstanding kind of falls apart when you look at all the steps they didn't take.
Yeah, and that's where it gets real, because I don't think this was an oops moment. I think this was more like, let's see how far we can push this. And when it didn't go their way, they pivot to damage control.
So it's not really some deep, complex tax drama. It's more like, let's roll the dice and hope nobody notices, right?
It reminds me of how we used to handle stuff like this in the 90s. Like back then, you might bluff your way through an audit. But these days, revenue's got systems, there's structure. You can't just charm your way out. If you take the right steps, though, there's a path. You can actually make this work for you.
One of the most critical steps is making the voluntary disclosure. Because without it, you risk being publicly named. But here's the catch. It's not enough to just come forward. You also need to make a payment, or at least a credible payment plan. That puts real pressure on people who simply don't have the funds. This developer made no mention of that issue, which suggests it wasn't a factor in his case. But for many others, it's a very real and often overlooked hurdle.
So the big takeaway? Don't assume an accountant is automatically an audit expert. When the revenue comes calling, you need someone who lives and breathes this stuff. A tax expert like you guys. Okay, so the next story. It's got drama. It's got deadlines. It's got diesel. What's this about?
A Northern Ireland company puts in a VAT refund claim for about 7 grand on diesel they bought in Ireland in 2022. All good, except they filed the refund claim 3 days late, and Revenue said no.
3 days? I've left sandwiches in the fridge longer than that.
Yeah, and the kicker, the company's director had been in a serious car accident. He was in hospital, in recovery, the whole 9 yards. But Revenue didn't care. They looked at the date, saw it was 3 days over, and that was game over for him.
I mean, this is the bit where your faith in flexibility goes to die. Because they weren't being reckless. The guy was actually injured. But the system, it doesn't care. As Derek said, it was a Northern Irish company which, thanks to Brexit, means they're now non-EU in VAT terms. That throws you into this lovely little process called the 13th Directive. And under that, you only get until the 30th of September of the following year. That's your lot. No leeway.
So you could be wrapped in bandages, dictating the form with your eyebrows. Still no dice.
Yeah, it's binary, on time or not.
And what's worse, it's not even rare. There have been other cases, similar fact profiles, and the same outcome.
Meanwhile, Irish-based businesses have 4 years to file a VAT reclaim. 4.
And to be honest, most businesses don't even realise the clock's ticking that fast. They're dealing with VAT in different countries, different rules, and they assume someone somewhere will cut them a bit of slack.
Okay, so for the folks listening, what do they need to actually do to not end up in this mess?
Okay, so here's the plan. Set your own deadline at least a month before the official one. Build in panic room time. And if you don't know the system, get help or risk losing a lot of money.
So basically, reclaiming VAT in Ireland when you're not based here is less admin and more Olympic sprint.
That's it, Josh. And the starting pistol went off last year.
All right, I love this next case. It involves 477 grand in gifts, communion money, and a tax bill that landed like a brick. Talk to me. What exactly happened here?
Josh, we're talking about a 32-year-old guy who got nearly €500,000 from his parents between 2017 and 2021. And on top of that, they paid him another 19 grand in 2018 from post office savings certs.
Okay, generous parents, but why did it all end up in front of the Tax Appeals Commission?
Because Revenue came knocking with a gift tax bill, 65 grand in total to be precise, and the son wasn't having it. He appealed, saying most of the money wasn't taxable because it came from years of small exempt gifts. You know, birthdays, communions, sporting medals, a few crisp tenors from Auntie Mary.
And what exactly was his case?
At the hearing, the father, who's a solicitor, said that 105 grand of the 2017 transfer wasn't just a one-off. He claimed it was the cumulative result of small annual gifts from both parents going back all the way to 1992 when the son was born. He said they each mentally earmarked the maximum small gift allowance every year, starting with £500, €750, then 3 grand, and they just kept it in their own joint account. No transfers, no separate account, just a long-term mental tab.
Apparently. And their proof? None. No records. No account in the son's name. Just the father saying, "Trust me, we kept track with the pen and paper." Which, by the way, is not how the tax system works, or any system that involves money, really.
And what about the post office money, the 19 grand?
Same story. They claimed it was built up from small gifts over the years, including communion and confirmation money, saved in post office savings certs. The father even threw in 2 great aunts, said they gave 42 grand between them over the years. But again, nothing in writing, not a scrap of documentary evidence.
So just to be clear, the whole case was riding on stories, not statements.
Exactly. The commission couldn't accept it. I mean, there were no records, no dates, no bank trail, just family lore and a solicitor's word. Listen, he said, "In the January of each year, I ascertained how much I could give him in relation to the small gift exemption payment. And as his guardian, I basically earmarked that in my accounts as something that I would hold and retain for him. There was no question of me doing it any other way, as it was done from the year of his birth."
And the takeaway?
If you're going to claim 25 years worth of small gift exemptions, You need more than a spreadsheet you filled in last week. You need actual transfers, documentation, maybe an account in the kid's name would help. You know, things that exist. But mental earmarking is grand when you're planning a weekend away, not when you're dealing with a tax case. Could you imagine if we all went around mentally earmarking our mortgages?
So there it is, a story of mental earmarking, memory-based accounting, and the revenue commissioners holding the line like a nightclub bouncer with a clipboard. But is that the end of the story?
Not quite, Josh. In fact, it might just be the intermission. The Tax Appeals Commissioner has been asked to state and sign a case for the opinion of the High Court, which means this thing could be heading for round 2.
And look, if it makes it to the High Court, we might be in for even more quotes. I mean, if the arguments in the first round were colourful, mental earmarking, guardian cash handling, decades of undocumented gifting, sporting prowess, just imagine the courtroom transcript next time. It'll be part tax law, part theatre.
So we could be going from Trust Me, I'm a Solicitor to Exhibit A, Communion Envelopes 1992-1995.
Exactly. And this time there'll be more at stake, not just for the family, but potentially for how small gift exemptions are interpreted going forward. So yeah, it's still unfolding.
All right. So lesson remains the same. Keep records, document your gifts, and don't rely on your memory or your legal title to argue with revenue. Right, and that's the news gone. Let's take a break, after which we'll turn our attention to the main focus of this episode, growth shares.
Running a business means making big decisions. And when it comes to taxes, those decisions can have a lasting impact. Whether you're navigating complex property transactions, planning a corporate restructuring, or optimizing shareholder remuneration, you need a strategy that works for you. At CoVenture Tax Consulting, we specialize in tax planning solutions tailored for businesses. Partner with CoVenture Tax Consulting and unlock tax strategies that align with your goals. Visit coventure.ie, your trusted partner in smarter business tax planning, to schedule a consultation.
All right, we've had our tax news fix, we've taken our break, and now it's time to dive into the main event. We're talking growth shares, not your average payslip bonus, not your Friday pizza perk, but a way of saying to key employees, you're in this for the long haul, and if we grow, you grow. But as well as a way of rewarding employees, growth shares are a valuable estate planning tool. So, what are they? How do they work? And why are more and more family companies looking at them for tax planning? Derek, Daphne, let's crack this open.
Well, as you know, companies have always needed ways to motivate employees. In the 20th century, we saw stock options become a staple in big corporations. You might be forgiven for thinking that the idea of giving people a slice of the business started then, right?
That's what most people think. But let me tell you something.
Are you saying that equity-based incentives started before the 20th century?
Back in the 19th century, companies like Cadbury in the UK embraced welfare capitalism, offering housing, healthcare, and education to boost worker well-being and productivity. During the Industrial Revolution,
Between 1700 and 1800.
yeah, that's right. This is when money became the dominant motivator. People were paid wages based on hours worked or output. Employers often offered company housing and food, particularly in towns with mines or mills. But this tied workers to the business economically and socially.
Between the 1500s and the 1700s, the time of the early capitalist and craft economies, motivation was more personal. Workers were paid per piece produced, known as piecework, linking their reward to productivity.
Going further back to the feudal and pre-industrial era, motivation was less about advancement and more about survival. Peasants worked land in exchange for protection and food from their lords. Guilds offered a rare path for upward mobility, with apprentices working towards the rank of master, gaining both respect and economic security. In many cases, work was also deeply tied to religion. Diligence and obedience were seen not only as social duties, but as spiritual ones, with the promise of divine reward.
Yes, the Platinum Afterlife package. Work hard, suffer nobly, say nothing, and at the end of it all, if you're very good, you get to spend eternity with a bunch of saints in a cloud-filled housing estate. Okay, this is all very interesting, But what does it have to do with giving equity before the 20th century?
While much of Western Europe between the fall of the Roman Empire and the dawn of industrialization is often labelled the Dark Ages, a period marked by feudalism, rigid social hierarchy, and the dominance of religious authority, a very different story was unfolding on the other side of the world.
You're talking the Islamic Golden Age in Central Asia.
In cities like Baghdad, Samarkand, and Chang'an, societies are thriving. Centres of trade, learning, and cultural innovation flourished under the Islamic Golden Age, especially in parts of Tang and Song dynasty China. Scholars in the East were translating Aristotle, developing algebra, advancing medicine, perfecting papermaking, and exchanging poetry along vibrant trade routes. It wasn't dark everywhere.
Exactly, and those trade routes were more than just highways for silks and spices. They were arteries of ideas. The Silk Road, for instance, didn't just move goods from China to the Mediterranean. It carried philosophy, mathematics, architecture, even fashion. You had Persian astronomers talking to Indian mathematicians, Chinese inventors influencing Arab scientists, all through these bustling cities that were centuries ahead in literacy, urban planning, and commercial innovation. The East wasn't just trading, it was thriving.
Right, and here's the thing, they weren't just cultural hubs, they were economic powerhouses. People were working, trading, generating real wealth. Merchants, artisans, bankers, caravan operators.
Caravan operators?
Your equivalent of DHL, FedEx, and UPS. Caravan operators played a crucial role in managing the movement of goods. Silk, ceramics, tea, paper, spices, across vast and often dangerous terrain.
And with all that activity came a need for structure. You had early forms of partnerships, investment pooling, and commercial contracts in places like Cairo, Damascus, and Xi'an. Workers and skilled tradespeople weren't just cogs in a feudal machine, they were part of a dynamic urban economy. Employers needed ways to attract and retain good talent, even back then. But Josh, the earliest known examples of equity shares in companies actually came from China over 1,000 years ago. Long before Wall Street and before the Amsterdam Stock Exchange, merchants in China were already pooling their money and investing in joint ventures.
I thought equity and stock markets were invented in Europe.
The concept of shared business ownership existed as far back as the Tang dynasty, 600 AD. Merchants would buy into trading ventures, sharing both the risks and the profits, just like today's shareholders. Imagine you're walking through the bustling streets of Hangzhou in the Song dynasty. The air is thick with the scent of roasted duck, incense, and fresh ink from calligraphers selling scrolls on the side of the road. Silk merchants unfurl bolts of the finest fabric, dyed in deep reds and golds, shimmering under the lantern lights. The clinking of copper coins echoes through the market as traders haggle over tea leaves from Fujian or fine porcelain destined for Persian courts. The city is alive, thriving, a hub of innovation, finance and global trade. And in the back rooms of grand tea houses, deals are being struck, investments pooled, and merchants calculating their next venture. This was the world where the first joint stock businesses were born.
Wow, what a picture. That sounds more like Wall Street with dumplings. But that makes me wonder, when we talk about modern stock markets and things like growth shares, are we really just reinventing the wheel?
From medieval China to Renaissance Europe, different share types have been shaping commerce for centuries, Josh.
Wait, hold up. People were already thinking about shared business ownership over 1,000 years ago. Fascinating. Just fascinating.
Oh, absolutely, Josh. People have been organising work and sharing risk for millennia. And it's not just business. Long before Maslow gave us his hierarchy of needs in 1943, around 350 years BC, Aristotle was writing about eudaimonia, or human flourishing. He laid out a kind of hierarchy of human pursuits, starting with basic survival, sure, but leading all the way to intellectual growth, virtue, and the good life. So the idea that people would collaborate, invest, and build things together, it's ancient and deeply human.
China was exporting luxury.
This sounds like an advanced civilization.
Ancient societies had polymaths, inventors. They came up with the magnetic compass and revolutionized navigation and trade. They had early paper money systems and sophisticated markets.
This is insane. So where were all these goods going?
Everywhere. The maritime Silk Road stretched from China to India, the Middle East, and Africa.
Did they have physical stock markets, or was this more of a handshake economy?
Mostly contracts and reputation. In China, business was built on trust and relationships.
The first European joint stock company was the Société du Moulin du Bazacle in the 14th century France.
So medieval France had stock markets before they had modern plumbing.
And then in 1602, the Dutch created the Dutch East India Company, VOC, the first company to sell publicly traded shares. The VOC ran a trade empire from Indonesia to Japan and India, moving nutmeg, cinnamon, and pepper, stuff people were willing to kill for.
So the East is flourishing between 600 and 1600 AD, while in the West, all is sort of quiet until around the 15th century. They must have shaped entire societies, right?
Yeah, in the East, Guangzhou and Quanzhou were the ancient equivalents of Shanghai and Hong Kong, and they still exist today. Guangzhou is a massive modern metropolis with a population of about 15 million. It's a major commercial and manufacturing hub in China. Quanzhou, while less internationally known, has a population of 9 million. It's an important city and is recognised for its historical significance as a key port of the maritime Silk Road. You can still visit ancient sites in Quanzhou that showcase its rich trading past, like the Kayan Temple and the Maritime Museum, where artefacts from its global trade connections are preserved.
So it turns out shares, or at least the idea of sharing in a venture, go way back further than I thought. But the need to reward people for their effort, risk, and loyalty, that's as old as trade itself. These days, one of the more sophisticated ways to do that is through growth shares. Daphne, bring us into the present. What exactly are they, and how do they work?
Growth shares are a special class of ordinary share that typically start with a low or nil value and only become valuable once certain performance targets or hurdles are reached. These hurdles could be tied to company-wide performance and individuals' achievements or other conditions set by the company.
So they act as an incentive for employees?
They're designed to align employee and company interests. Since employees benefit financially only when the company achieves its targets, they're motivated to contribute to that success. Employers also like them because they provide a way to reward employees without immediately diluting existing shareholder stakes. But as we'll also discuss, they provide very interesting tax planning opportunities to owners of family companies looking to pass on shares to their children.
Interesting. Now let's get into the tax side of things. If an employee is awarded growth shares, how is that taxed?
It depends on how they receive them. Let's talk about how shares are generally taxed first. If an employee is granted shares at market value and pays in full upfront, there's no immediate tax liability. However, usually shares are provided at a discounted price. In these situations, the difference between the market value and the subscription amount paid is considered a taxable benefit. In that case, income tax, USC and PRSI apply, and the employer has to deduct these through payroll.
So, if I receive shares worth €1,000 but I only pay €400, I'm taxed on the €600 difference.
That's correct.
And what about capital gains tax, CGT?
Well, CGT comes into play when the employee eventually sells their shares. The tax is charged on the gain, which is the difference between the selling price and the initial cost at which the shares were acquired.
That is the price for BIK purposes.
The current CGT rate is 33%, but employees can use the annual CGT exemption, currently €1,270, to reduce their taxable amount.
But for growth shares, especially those designed to have no initial value and to acquire value as the business grows, there is often no upfront income tax exposure. That's a significant benefit, and while attractive to employees, where growth shares really come into their own is for long-term estate planning, transferring a business to children or other family members.
And if I've learned anything from listening to you both on this podcast, it's that Ireland's gift and inheritance tax reliefs are severely lacking, which makes this angle very interesting.
That's right. The first step in designing a growth share for a business is to ascertain what is the existing value and how can the growth share be designed to only acquire value from future growth. If an employee sells their shares and underdeclares the gain, revenue may challenge the valuation, leading to potential penalties.
Equally, if a family member receives growth shares which are in the money, that person will have a tax problem.
And just how do companies need to be valued when employing growth shares?
There are industry norms that apply, and we would generally recommend having a corporate finance expert provide an independent valuation with inputs from the company's internal or external accountant. Collectively, they'll produce a report for tax purposes.
Is it generally the position that growth shares will have no value when allotted?
In theory, yes, but consideration has to be given to the potential of the shares to acquire value. And this is something that must be factored into their initial valuation. Without getting too complicated, the role of a tax advisor when it comes to valuations is to ensure that the most up-to-date techniques are used by the independent experts.
For example, when it comes to valuation techniques, apart from just picking a multiple factor, we coordinate with the relevant advisor to ensure that probability-weighted expected return methods are used if relevant.
Those sound super technical. How do they work?
There are different model types, possibly a subject for another pod, but in simple terms, you might want a valuation to include future scenarios. Scenarios such as a company sale, an IPO, or continued private growth, with an assignment of probabilities to each potential outcome. The expected return from each scenario is weighted by its likelihood to estimate a fair share value today.
In very large companies, models could potentially have hundreds of variables linked to market conditions, volatility, and business performance. The outcome could be a probability distribution of different share values.
So it might be naive to assume that a growth share has no value.
It's more likely to have very low rather than no value. The key takeaway, especially for families looking to growth shares for long-term planning, is to have an independent external valuation underpinning tax submissions. Otherwise, you leave yourself vulnerable to a revenue challenge.
So what happens to growth shares when they're passed down as part of an inheritance? I assume they'd be taxed like any other asset. Or do they qualify for some kind of relief?
That's where it gets interesting. Certain business assets qualify for business relief, which can reduce the taxable value of shares for inheritance tax purposes by up to 90%. But growth shares don't automatically qualify for business relief.
Why not? If they're part of a business, wouldn't they count the same as other shares?
Not necessarily. To qualify for business relief, the shares must be in a trading company or a holding company of a trading group, not an investment or passive asset company. Since growth shares often only gain value when certain conditions are met, they could be seen as an investment rather than an active business interest.
And there are also ownership and holding period requirements. So the person transferring the shares must have held them for at least 2 years before their death or transfer, and the recipient usually needs to keep them for a certain period, currently 6 years, to maintain the relief.
So if the growth shares are tied to an active trading business, they might qualify, but if they're linked to investments or held in a non-trading company, they probably won't.
That's why structuring growth shares properly is crucial. We've worked with clients to ensure their ordinary shares are aligned with business relief rules, avoiding unexpected inheritance tax liabilities. Because if business relief doesn't apply, the shares could be subjected to inheritance tax at 33% on their full value. That can be a significant tax burden for heirs who weren't expecting it.
Equally, we've helped businesses implement growth shares. Shares are granted with minimal value, but carefully structured so that the future business growth flows mainly into those shares. The result is the creation of a highly valuable share class, usually owned by the next generation, usually without any upfront tax consequences.
And what happens next? As value flows into the shares, this value bypasses any inheritance and is neatly passed on to the next generation tax-free. Very clever.
Josh, if you think this through, planning ahead really matters. If someone's thinking about passing down growth shares, they should really get started early.
Very interesting. If you've got a growing valuable family business, a growth share scheme can be a game changer.
Definitely. The earlier it's put in place, the more time it has to grow, and the more tax efficient it becomes. A longer runway means more potential value passed on with less tax paid. When it comes to share schemes, you really can't start too early. We always tell clients, review your structure well in advance. The future you will thank you.
So there are two case uses for growth shares: rewarding and retaining key employees and estate planning. In the estate planning world, growth shares provide a powerful solution to avoiding gift and inheritance taxes.
Yeah, growth shares let you pass on the future upside of your business, not its current value. That's huge. So instead of handing over part of the company today and getting hit with a big tax bill, you're giving your kids or a trust a stake in what the company might become. So you're basically freezing your estate's value now while still sharing in any future growth. You keep control, avoid unnecessary tax exposure, and set up the next generation in a way that's clean and strategic.
It's smart, and honestly, it's still not widely talked about outside of boardrooms or tax circles. But for succession planning, growth shares are one of the most elegant tools out there.
Brilliant, Daphne and Derek. I'd love to continue this conversation, but I'm afraid we're all out of time. Hey listener, we've had great feedback and more requests for new topics than there are tea varieties in Hangzhou. So we're introducing a new segment, the Tax Relief Spotlight. First up, here to unpack the Dwelling House Exemption is our production engineer, Rory.
Dwelling House Exemption is an extremely valuable relief designed to reduce inheritance tax burdens related to residential property, especially family homes. Under this exemption, individuals inheriting a dwelling house may qualify for a complete exemption from inheritance tax, provided specific conditions are met. The inheritor must have lived in the property for at least 3 years prior to the inheritance. They must not have a beneficial interest in any other residential property at the date of inheritance, and they must continue to occupy the house as their primary residence for 6 years after the inheritance. This exemption enables transfers of homes free of inheritance, and it's particularly beneficial where heirs reside with elderly relatives, ensuring continuity and reducing financial strain. While the scenarios where full exemption are available are limited, with careful tax planning, it is possible to expand the relief to situations where it would not typically apply. If you're serious about securing this relief, don't assume your accountant or solicitor is across this. While they may be trusted advisors in their respective fields, this is a specialist area that sits outside their expertise. So make sure to speak with a tax expert on this.
And with that, we've wrapped another episode of Irish Tax Unwrapped. Today, we went from medieval marketplaces to modern boardrooms, tracing how motivation, reward and risk sharing have evolved over 1,000 years. From copper coins and calligraphy to KPIs and capital gains, one thing's clear: growth shares may be the new kid on the tax block, but the idea behind them is ancient. So whether you're scaling a business or planning a legacy, it's worth remembering. The right structure now can save a fortune later. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, keep your finances in check and your tax knowledge sharper than a Silk Road negotiator.
If you enjoy Irish Tax Unwrapped, please rate, subscribe and share the podcast. If you've any questions or topics you'd like us to cover, please contact the show on X @TaxUnwrapped or email the show podcast@taxiq.ie.